Hey everyone, and welcome to This Explainer. Today we're unpacking a really powerful framework that reveals exactly how inflation actively drives central bank policy and ultimately dictates the investment cycles that shape our portfolios. We're going to look at a framework that takes all that raw, confusing economic data and translates it into clear, cross-asset investment strategies. Let's kick things off with kind of a wild paradox. Think about this. Why does a 3.5% inflation rate terrify some countries, but perfectly comfort others? It instantly proves a golden rule of economics. Headline numbers on their own are completely meaningless without context. You literally cannot just look at a 3.5% print and know what it means for your investments without digging beneath the surface. So we're going to treat economic data like a detective's board today. We'll follow this exact roadmap. We'll start with the psychological anchors, figure out how to filter the true signal from the noise, understand the central bank's next move, and finally, track that transmission straight to your portfolio. All right, part one, the anchors of inflation. This is literally the psychological foundation of the entire economy. Before we even peek at any raw statistics, we have to establish the two foundational forces that shape absolutely everything else. The crucial point here is that expectations, both survey and market-based, alongside the institutional credibility of the policymakers, are the true anchors. Think of them as the unseen gravity that ultimately determines real interest rates, asset pricing, and whether an inflation trend is sustainable or about to spiral out of control. And this right here perfectly captures why that 3.5% number from our opening question can be totally fine in a developed market, but absolutely terrifying in an emerging economy. If a central bank has a 10 or 20-year history of keeping inflation in its target band, markets stay chill. But in an economy with a shaky institutional history, you run into risks of fiscal dominance, where government debt basically forces the central bank to print money, or heavy wage indexation, where contracts automatically jump up with inflation. In that scenario, that exact same 3.5% triggers absolute panic, because investors know it can multiply overnight. Now that our anchors are firmly set, let's move to part two and figure out how to filter out the headline noise so we can find the true signal. When you're breaking down a headline inflation number, the golden rule for investors is to visually ignore the wild, volatile swings in food and energy. I know, it's hard, but you've got to do it. Instead, laser focus your analysis on the persistent components, core goods, and especially core services. Because guys, that is where the real sticky inflation actually lives. For your portfolio, distinguishing between a temporary, one-off shock and a terrifying new structural regime shift is absolutely critical. A level shock is just a bump in the road, like a sudden change in a value-added tax, a fuel adjustment, or a tariff hike. It's weather, not climate, right? It moves prices up once, but it doesn't change the ongoing trend. A regime shift, on the other hand, is a deep structural change. You'll see rising core inflation, those psychological expectations becoming totally unanchored, and wage growth persistently outpacing productivity. You also have to play detective and figure out the culprit behind the numbers. Is the inflation demand-driven, meaning the domestic economy is just running incredibly hot with broad-based price and wage pressures? Or is it supply-driven, meaning we're just importing expensive energy, suffering from global bottlenecks, or getting hit by a weak exchange rate? The source of the fire completely dictates how it's going to be fought. Let's look at the labor market for a second to see how this builds. The most durable, stubborn, inflationary pressures almost always come from the interaction of wages and productivity. This is exactly why we must continuously track this chain reaction, from wage growth rates across different sectors to productivity measurements, and finally, how that impacts unit labor costs. Simply put, if wages are rising faster than a worker's output, it's going to violently eat into corporate margins. To do this effectively, our source material advises using established time series techniques to separate the real signal from the noise. That means isolating the trend from the cycle, evaluating mean reversion, which is really just the tendency for weird spikes to eventually return to historical averages, and tracking how inflation moves alongside credit, housing, and foreign exchange. The goal isn't to overmodel the data to death here. It's to bring some judgment and discipline to your process, rather than just panicking and chasing every single noisy monthly data release. Okay, once we found that true signal, we arrive at section 3, which is honestly the most critical pivot point for markets in our entire explainer. Literally every single time an inflation data report drops, before you even touch your portfolio, you must stop, take a breath, and ask yourself this exact question. Will this data move the needle on expected policy rates? Because the reality is, for government bonds, foreign exchange, and equities, the raw data doesn't actually matter in isolation. What dictates the investment cycle is whether that data forces the central bank to change the timing or the pace of their rate cuts and hikes. The expected policy path is the true driver of asset prices. Think of central banks as the ultimate referee of the economy. Generally speaking, they're far more likely to just look through or ignore a one-off spike at the gas pump or a temporary shipping bottleneck. But what the referee will aggressively attack is persistent services inflation and unanchored wage-driven trends. If wages are spiraling, the central bank is going to step in with higher rates to cool the game down. Let's move to our final section and see how this central bank reaction function trickles all the way down to corporate balance sheets, household wealth, and your specific investments. This creates what we call a cross-asset waterfall, showing exactly how different parts of a portfolio react to the inflation signals we just decoded. For government bonds, it's all about that expected policy rate path we just talked about. For equities and credit, the divide is brutal. You want sectors with the pricing power to pass on costs to the consumer, and you want to completely avoid those that can't. For Forex, it's about real yields and external balances, and for real assets, it's all about hedging demand. This right here is how macro data becomes an actual investment strategy. And hey, this isn't just for Wall Street traders. If you're making commercial or corporate decisions, the current inflation regime directly dictates your reality. It impacts your loan pricing, the timing of your major capital expenditures, your working capital needs, and critically, how you structure your company's balance sheet, like whether you should be taking on fixed or floating debt or local versus foreign currency liabilities. But as we look at the broader economy, we also cannot ignore the distributional vulnerabilities happening right beneath the surface of the headline market numbers. Inflation does not hit everyone equally, not even close. These distributional effects are massive. You've got to compare the inflation rate for absolute essentials like food, energy, and rent against the headline rate because essentials hit lower income groups way harder. Tracking real wage trends across different income brackets and margin pressures in low-margin sectors is super vital because these inequalities ultimately drive massive political risks, shape government policy choices, and rapidly shift consumer demand patterns. Ultimately, all of this creates a really powerful self-reinforcing cycle. Inflation and changing interest rates alter real household wealth across housing, savings, and equities. These changes in wealth, combined with new interest rates, shift the burden of debt servicing costs. And that final step creates a feedback loop that will completely amplify or severely dampen broader consumption and business investment. It dictates the entire economic cycle. So, to keep your finger on the pulse of all this in the real world, here is your daily toolkit. These are the specific metrics you need to continuously track: headline and core CPI, upstream cost pressures like PPI, those critical wage and unit labor cost figures, and the psychological anchors we talked about at the beginning, both survey-based and market-implied inflation expectations. I absolutely love this quote from our source material because it cuts right to the heart of why we do this. Sound inflation analysis should conclude with very sound interpretation. It reminds us that merely listing economic statistics is basically useless if we don't translate them into actionable market reality. The real value is in the interpretation, not just the description. So look at your own investments or your corporate balance sheet today and ask yourself a tough question. Are you just reacting to noisy headline numbers, or are you actually positioned for a true regime shift? Find the signal, understand the referee, and let that guide your investment cycle. Thanks so much for joining me on this explainer, and I'll see you next time.